The ICE fund had several really strong contributors for the June quarter. First of those was Catapult, a stock we've held in the fund for many years. Catapult held its annual investor day and also its annual results, and both were really well received by the market. They have an extremely energetic management team, and they continue to lift the bar on innovation and customer service in their field. And they're really pursuing ambitious multi-year targets for success. We just see that this behaviour is consistent with being the industry leader. Catapult has entrenched itself as the leading provider of sports performance software and continues to do that, continues to add teams, continues to add products, continues to deliver cash flow. So that's been a real positive for the fund in the quarter and the last 12 months. The next contributor I'm going to discuss is Tasmea, a more recent addition to the fund. Tasmea first IPO'd 2 years ago, and we followed the stock and invested late last year. Tasmea provide technical, high-value add service to their clients in the electrical and maintenance services field. They deliver a really good margin too, which in our eyes highlights the value of their franchise. Some of the work they do is remote and competitors are scarce. And a lot of the electrical work they do is going into a lot of innovation and a lot of the build that we hear and talk about in respect to the energy revolution. So we believe Tasmea is really well placed to benefit from those trends. A third business I'll discuss is Life360. We've owned this company now for 5.5 years. Their update in May just continued to highlight how entrenched that business is. Their brand in family location sharing services globally continues to expand. They now have 84 million monthly average users of their product. It's an incredibly impressive platform of eyeballs. Facebook Messenger and WhatsApp have more average daily users inside the US, but outside of that, Life360 has the most. And when you consider how competitive that market is, that's a really impressive set of numbers. But for Life360, it's not just about eyeballs. Profit from subscription services continues to grow at very healthy rates. And their advertising business, where they're targeting those eyeballs, continues to build. And although the current revenue is quite modest, there are many precedent for apps scaling that advertising revenue and profits materially. And we do see the early indicators there that they can build an advertising-focused profit stream from this huge number of eyeballs. And that's why we have continued to invest, despite the fact the stock is up nearly 17-fold since we first invested. Monash IVF was a key detractor for the fund across the June quarter. The share price weakness was triggered following what's best described as an incident at their Brisbane clinic, where tragically the embryo of one patient was incorrectly transferred to another patient, resulting in the birth of a child. This is a really stressful and emotional period for all those involved, and we do recognise that. At the time, our considered view was that a business with a strong brand and a reputation that Monash enjoyed would survive the potential brand damage of such a mistake. This proved incorrect, as later in the quarter, Monash actually had a second embryo error. Not quite the same, but a second error, and on that basis we elected to sell our position. We believe the strength of the franchise was considerably weaker. We talked to fund positioning. The fund is now in its 20th year, and we always seek investment opportunities predominantly in the small industrial segment of the market that meet our franchise criteria. ICE seeks companies with assets that are difficult to replicate, customers who are sticky, and a business that is well managed such that those customers remain sticky. Critically, we seek a strong internal rate of return, which really stresses the importance of paying the right price for those assets. Within the fund, some examples of those business franchises: EBOS, a wholesale distributor in the Australian healthcare market. They have critical infrastructure. They've been operating for nearly 100 years, serving pharmacists, hospitals, and doctors. Catapult is the industry leader in sports performance software. We still hold a very healthy position in Catapult. The product is becoming more and more entrenched. Sport is expanding, and it attracts eyeballs and revenues that come with it from an advertising perspective. Elite sport is growing everywhere, whether it be by region, more women's teams entering the professional sphere, or more sports. Even in the last 2 years, Catapult has begun to win business in baseball, a sport where it had previously had only modest success. And finally, Port of Taronga is New Zealand's largest deep water port A third of the tonnage and cargo that comes into and leaves New Zealand passes through this port. It's a physical asset. It's deep water and carries the associated infrastructure that makes Port of Tauranga a critical piece of New Zealand's assets and infrastructure. Port of Auckland nearby is facing capacity constraints and congestion issues, and this is only increasing both the value of Port of Tauranga to importers and exporters, but also the pricing power which they are able to extract. During the quarter, we made some adjustments to the portfolio. Early in April, for example, we were very active when volatility peaked and markets fell. Principally, we added to existing positions at the time, including Pinnacle, Port of Tauranga, and ResMed. Across the quarter, we added new positions, including Australian Ethical, SRG Global, and Auckland Airport. Auckland Airport is, of course, a virtual monopoly. It's the major aeronautical entry point to New Zealand and the Auckland capital. Over the coming years, Airport plans considerable expansion of both the terminal and its freight and warehouse capability. This should see volumes of cargo and people increase and considerable profit growth as the infrastructure is built out. We did take some profits in the quarter in Catapult, which I've discussed, and we exited our investments in both Monash IVF and Emotive. So why should investors consider the ICE fund now? It's certainly not new news, but it still holds true that small caps have continued to underperform the broader market in Australia over what is now the last 3.5 years. This is an extensive period of time, and we believe that the stars are aligning for this to unwind. With our own fund, we have just experienced a period of underperformance against the small industrials. Again, the fund is benchmark unaware, but over the 20-year life of the fund, if you did choose to invest in the fund at periods where underperformance had occurred, these would have driven some of the better periods of outperformance over that time period. And we have data which supports that over 1, 3, 5, and 10 years. In fact, over time, the ICE fund has delivered some 5% alpha against the small industrial segment of the market. In terms of outlook and expectations for the coming quarter, at ICE we have a strong bias towards observing what goes on in the world of investments rather than predict, particularly when it comes to the short term. That said, August captures reporting season for the bulk of Australian listed companies, and we always look forward to that. We look forward to engaging with the management teams of the franchise companies in which the fund is invested. What are we excited about? We look forward to updates from companies in respect to how they are using AI. Temple & Webster, Life360, MA Financial and others. We're expecting to hear some fascinating insights there. Macquarie Technology, who sell data centre capacity, well, we're certainly looking forward to updates on how their pipeline continues to evolve. AI companies will need to utilise data centres more and more, and we believe that the demand and supply imbalance favours Macquarie Technology. In terms of small companies, we're always following a bunch of investments, potential investments, and looking forward to the next update to confirm our views about the management, how fast that company is growing, how sticky the customers are, and whether that company is franchise worthy. And ideally, we look forward to pulling the trigger on a few new investments that will drive returns for the ICE fund in the years to come.
This fund update has been prepared by SG Hiscock & Company to provide general information only and is not intended to take the place of professional advice, and it does not take into account the investment objectives, financial situation, or particular needs of any particular person. Equity Trustees is the responsible entity for the fund. Neither SGH, Equity Trustees, nor any of its related parties provide any warranty of accuracy. Past performance should not be taken as indicator of future performance, and you should obtain a copy of the product disclosure statement before making a decision about whether to invest in this product. Follow the link in the description for the full disclaimer.